Hi, I'm Noel Daly. I'm the F7 lecturer here with Griffith College in Dublin, and today we're going to take a quick look at a topic which is fairly common and has surfaced on a number of occasions over the past few years with the examiner. It's construction contracts, IS number 11, and we're going to take a look at an exam question where I'll show you just one or two of the techniques that are needed to be followed to get this question completed and get marks in the bank. The construction contract is a contract essentially which deals with the construction of an asset that takes a long period of time to get ready for use. So we're talking about things like building bridges, we're talking about motorways, we're talking about ships. And by their nature, these contracts are completed over more than one accounting period. If the project was started and finished in a single period, then there would be very little accounting issue for us. We'd have the revenue in the period, we'd have the costs in the period, we'd match them, and we'd calculate the profit or loss for the period. But the problem we have with IS number 11 is that IS number 11 deals with these contracts whose outcome is a little uncertain, perhaps over a number of years. And so what we've got to do is track the profit or loss of this contract over the entire duration of that contract. Now, traditionally, it's seen as a slight battle between two important principles in accounting, that of accruals and that of prudence. Accruals basically says that we recognize income and expenses as they are earned and incurred. And so over the duration of the project, as the project unfolds year to year, accrual says we should recognize these revenues and costs as the project progresses. But what prudence says is that we should not recognize profit until that profit has been realized. And so essentially, we should not recognize profit until the project is effectively complete. So IS number 11 is kind of a middle ground, a halfway house that tries to reconcile these two principles. And so it establishes the principle of the idea of the accruals winning out, but still at the same time being respectful of the concept of prudence. We will recognize profit on a contract as the contract progresses, maybe before the contract and long before the contract is completed, but at the same time, we'll only do so if we think this profit can be measured reliably. Now, this basically is called the percentage of completion method. And the percentage of completion method indicates that we recognize a certain amount of the contract profit as the contract unfolds. We calculate the percentage complete, and we use this percentage to calculate the amount of revenue and the amount of costs which are recognized in the P&L, and therefore we recognize the profit applicable to that particular period. There are three situations in examinations which we need to recognize as potential problems for us. The first situation is where we have a contract which is expected to be profitable. However, the profit can be estimated reliably. We are sufficiently far along in the contract to have a degree of confidence as to what that final outcome is going to be. Or we could also have a situation where, yes, the project is expected to be profitable. However, it is too early in the contract to have the confidence needed to say that with any great degree of reliability. So it may be, for example, that we have just turned the sod on a new particular project, literally done very, very little by the time our year end comes around, and certainly too early in the contract to say with any great degree of security or confidence that this project is going to be is going to be profitable at the end. The third situation which we have to watch for is where the project is expected to be a loss maker. Now, it would be unusual for us to take on a project which we deem to be a loss maker. This usually occurs where we have a project which was originally expected to be a profit maker, but things have happened as the project went along. Costs have escalated unexpectedly, and it has turned a project from what we thought would be profitable into a loss maker. Now, the loss maker we'll talk about in a moment because it's slightly different to the other two in the way that we approach it. But let's take a look at the first situation, number one, where the profit can be estimated reliably. Now, this is probably the most common situation in examination questions. And this basically, the idea here is that if the contract is at a stage when profit can be recognized, the revenue and the costs relating to that stage are calculated using the percentage of completion. So we estimate how complete is the project, 40%, 50%, 70%, whatever it turns out to be. And having calculated that percentage, we use that percentage then to calculate our revenue for the period and our cost of sales for the period as well. What we need to be very careful of, however, is not to double count previous years. So if the contract in the question is we are dealing with year 2 or year 3 or year 4, be very careful in the P&L not to bring in previous year's revenues and previous year's costs, because the P&L only deals with the current 12 months. So make sure that you exclude previous years from these figures. The second situation is where we expect the profit to be made on a contract, yes, but the contract is too early. It's too early by the end of the year to say with any great degree of confidence whether this contract is going to be profitable or not. So we might be, let's say, only 5% or 10% of the way through a 4 or 5 year project by the time our year end comes around. And the idea is pretty simple here. If we deem it to be too early to recognize profit, then don't recognize profit. Show neither a profit nor a loss. And what we'll do is we'll match the revenue with the costs. We look at how much costs have been incurred and look at how much of these can be recovered, and then make our revenue equal this amount, so that in our P&L, revenue and costs will be equal, no profit, no loss will therefore be shown. The third situation, which we refer to, is the loss-making contract. And with the loss-making contract, the idea here is that as soon as we anticipate a loss, all of that loss must be recognized in full immediately. Not part of it, all of it. So if the contract is profitable and we are, let's say, 60% of the way through the project, we recognize 60% of the profit. But if we are 60% of the way through a contract which is now expected to be a loss maker, we recognize 100% of the loss. All of the loss is now going to be brought in to the current year's accounts. Now, by way of example, I think a good representative question can be found in the June 2011 paper, question number 5, a question called MOCA. It was a 10-mark question in its day, and a good little question which highlights certain issues that are fairly ubiquitous. They tend to come up in the few examples that we have seen since 2008 in the past papers. It highlights a number of key issues, and I'm going to take you through that question. So if you can, download the particular question and read through the question with me, and I'll show you the main features of it and the main points that we have to watch for here. Now, when we look at the question number 5, it says in the requirements section to calculate the amounts which would appear in the income statement and statement of financial position of MOCA, including the disclosure note of amounts due to and from customers for the year end 31 March 2011 in respect of the above contract. So, to effectively show an extract from the accounts for March 2011. Now, at the start of the question it says that on the 1st of October 2009, MOCA entered into a construction contract that was expected to take 27 months and therefore be completed on the 31st of December 2011. Details of the contract are as follows. The agreed contract price was $12,500,000 and the estimated total cost of the contract excluding plant $5,500,000. Plant for use on the contract was purchased on the 1st of January 2010, 3 months into the contract, as it was not required at the start, at a cost of $8 million. The plant has a 4-year life, and after 2 years, when the contract is complete, it will be transferred to another contract at its carrying amount. Annual depreciation is calculated using the straight line method, assuming a nil residual value, and charged to the contract on a monthly basis at 1/12 of the annual charge. The correctly reported income statement results for the contract for the year ended 31st of March 2010 were as follows. So in the question, they give us what they reported in last year's accounts, the 2010 accounts. And in the 2010 accounts, they had revenue of $3,500,000 and they had contract expenses of $2,660,000. And so therefore, they recognized profit last year of $840,000. So at the end of last year's accounts, they must have been confident that the project was profitable and that this profit would ultimately be generated for the company. We're then told in relation to the current year, March 2011, details of the project which gives us the contract costs incurred to date, excluding the depreciation, $4,800,000. The agreed value of the work completed and billed to date, $8,125,000, and the total cash received to date, that is the payments on account received from the client, $7,725,000. The percentage of completion is calculated as the agreed value of work completed as a percentage of the agreed contract price. Now, what we need to do here is quite simply work out for the 2011 financial statements, what do we need to show in respect of this contract. And what I tell my students always with these construction contract questions is that before you begin, ask yourself 2 fundamental questions. And you ask these questions every year for every contract. And the answer may change from year to year. But ask the questions and then decide what action needs to be taken from that. So the first question that I need to ask is the contract expected to be profitable? Is the contract profitable? So let's write that down. Question number 1. Is the contract profitable? Now, what we need to do is look at what the contract price is, how much we are going to charge our client, and what they've told us in the question is that the contract price, what we will be charging for the job we are undertaking, is $12,500,000. From that, we need to deduct the costs. And he tells us that the estimated total costs are $5,500,000. But this does not include the cost of plant. In the question, he tells us that we buy a piece of plant and it costs us $8 million. This contract will only use the plant for 2 of the asset's 4-year life. So we will only have this asset for half of its life. So we bring in half of the cost. It makes sense that only half of the cost of this asset be apportioned to this contract. At the end of this contract, this asset will be moved away to some other project at the end. So if the contract plant costs $8 million and we're only taking into account half of that, then the plant that we need to consider will be $4 million. So, in answer to the first question, is the contract profitable? Yes, we think it will be. We now think that a profit of $3 million is likely to be made. Now, this may not actually occur at the end. Things change. Next year, who knows what the costs will be. Perhaps there's an escalation of costs unforeseen. But for the moment, this is our best guess. It's an estimate of what we think is going to happen. A profit of $3 million is going to be made. That's the first question. The second question that we need to ask ourselves is, what is the percentage complete? Because, as I've said, the standard says you can only bring in profit if you can estimate that profit reliably. And to estimate reliably, we focus on the percentage complete. Now, invariably in these questions, the examiner will tell you how to calculate the percentage complete. There are a number of possible formulae which could be used. But he tells us quite clearly here, at the very end of the question, that the percentage of completion is calculated as the agreed value of work completed as a percentage of the agreed contract price. Now, if you look in the question, he tells us that the agreed value of the work completed and billed to date is 8,125,000. And the contract price is 12,500,000. As a percentage, this is 65% complete. So we are 65% of the way through this contract. Therefore, we need to recognize profit for the current period on the basis that profit can be estimated reliably. So, how do we go about doing this? Well, quite straightforward, really. When you look at what's going to go in to the profit and loss, you look at the revenue figure first, and we know that we are going to charge 12,500,000 for the job. We are 65% of the way through the contract. And so, on an accruals basis, you could say that we have earned 65% of the revenue. And so we calculate 65% of 12,500,000. But remember, 65% is how far we are through the contract right up to date, including last year. And in the question, they tell us last year that the amount of revenue which was recognized was 3,500,000. So you need to take that 3,500,000 out, because that's last year's revenue. What you're left with is revenue for the current year. And revenue for the current year is therefore 4,625. So this is the amount of revenue I will show in my P&L for the current year. Now, we do exactly the same thing with my cost of sales. And if you look at the cost of sales, we can see that the total estimated costs of the contract, which we had established there a while ago, the total estimated costs of the contract were going to be 9,500,000. These two figures here, 9,500,000 were the total estimated costs of the contract. And so again, on an accruals basis, you could say, well, if the total cost is 9,500,000 and we are 65% of the way through the contract, then we should recognize 65% of the total costs. But again, remember, the 65% is from the start of the contract right up to the current year end. The 65% includes work that was done last year. So last year's figures again have to be taken out. And from the information in the question, the amount of the cost of sales recognized last year was 2,660. So as a result, the cost of sales in the current period is going to be 3,515. So I have revenue of 4,625, costs of 3,515. The amount of profit I therefore recognize for the current period 2011 is 1,110. That is the amount of profit which will be brought in to this year's accounts. By bringing in revenue of 4,625 and costs of 3,515, you automatically engineer it so that there's now 1,110 profit. Now, look at the profit. Last year, we had profit in 2010, it says so in the question, of 840,000. And in 2011 now, we're saying 1,110 needs to be recognized. So over the 2 years, we have now got 1,950 profit. That's the total profit that we have now recognized over the 2 years. And when you think about it, this makes perfect sense. Because in the first question that I asked you to consider, is the contract profitable? We said, yes, it is. The profit was going to be, we think, 3 million. And if we are 65% of the way through, therefore we should recognize profit of what turns out to be 1950. And that's exactly what we've done, but we have now spread it out over the 2 years of the project done to date. The 1950 matches the 1950 there. So that's the P&L sorted. Very straightforward. Look at the percentage complete, apply it to the revenue, apply it to the cost of sales, take off previous years to be left with the current year's position. And what of the statement of financial position? In the statement of financial position in this question, we'll have, well, two things, effectively. In the statement of financial position, as part of the property, plant and equipment, we will have this item of plant. And the item of plant would come into the statement of financial position at its original cost of 8 million. We then need to deduct from that the accumulated depreciation which has occurred since the plant was purchased. And if you look at the depreciation, we're saying that the cost of 8 million, there's a residual value, and it has a life of 4 years, or 48 months. So the monthly depreciation will be 2,500,000. Sorry, 2,500,000. It'll be 2,500,000 in total. Okay, so the question says to calculate the depreciation on a monthly basis. We do that by dividing the cost of the asset by its lifespan, and then multiplying it by the amount of months we have since the project commenced. And since the project commenced, we now have total depreciation of 2,500,000, so that the asset will now be shown at 5,500,000. Now, there's the asset. But in some questions, they don't give you details of the asset as such, and so we might not be able to, in a particular question, work out what the book value of the asset is. We can here, so we can put it in. Perhaps of more importance from the examination point of view, however, is to look at the construction balance. How much is effectively owed by the client on the asset itself? Now, to work this out, we use a pretty standard formula. We look at the costs to date. Not the cost necessarily that we have recognized in the accounts, but the costs that we have incurred to date. And the costs incurred to date, we can see in the question, he tells us that details of the progress of the contract at the 31st of March 2011, the costs incurred to date, 4,800,000, but that does not include the cost of plant. So we bring in the cost of plant, and the cost of plant is the depreciation. That's how we build the cost of plant into the calculation. We look at the depreciation, and we see that we have calculated depreciation of 2,500,000 on a monthly basis since the asset was acquired up to date. And so we have a total value of 7,300. There's your cost to date. Onto that, we add the total profit that has been recognized to date. And when you look at the total profit recognized to date, we said we recognized 840 last year, and we're bringing in 1110 in the current year, 1950. We add the 1950 profit that we've recognized to the costs, and so we arrive at a figure of 9,250, which, when you look at it, is a very crude estimation of the value of the work we have done. The cost that we have incurred, plus the little bit of profit that's added on for ourselves, 9,250. We compare this to what the client has paid, and we can see that the total cash received to date was 7725, or as they're sometimes referred to, the progress billings. The client has paid an amount to us of 7725. So you take this away, and what you're left with is the closing balance of 1525. Now this 1525 is a positive figure, and as a positive figure it is now a current asset. It goes into current assets rather like a receivable, but not as part of receivables. It's not like trade receivables, but it's kind of similar. So effectively what happens is that the client, in theory, owes us 1525. We've done work worth 9250 in theory. They've paid us 7725. 1525 remains to be paid. Now, that's not necessarily the amount they'll pay us next period, because that again depends upon the terms of the contract, how much they'll pay, when they'll pay, and so on. But what has happened is that the building work has gone ahead of the payments that have been made to date, and this figure, being a total figure, is referred to as the gross amount due from the customer. Now, in some questions, this might be a negative figure. So, for example, suppose that the progress billings were not 7725, but 10,000. Then they have technically overpaid us. So we will have a negative figure down below, and as a negative figure, it would be shown as a current liability. So, to recap, what have we got? In the P&L, we have profit of 1110 for the current 12 months, engineered by us bringing in a certain amount of revenue and a certain cost based upon the percentage complete. And in the statement of financial position, we have, if we can calculate it from the available figures, the book value of the asset, but more importantly, from an examination point of view, we have the contract balance, how much, in theory, the construction contract client owes us. It is a current asset in this question, 1525, and that's question mocha. That's it. That's that question. And if you look at similar questions in the past papers, you'll find similar issues arising. There are other slight complications that can arise, but we'll deal with these in more detail in class when we come to them. For now, however, I'll take my leave, and hopefully I'll see you in Griffith College pretty soon.